Give you an example of that. I was working out the other day at the health club, and at the end of my workout, I'm on the elliptical, which is face first with CNBC, the channel I never watch any longer. It was Squawk Box, and the bottom of the screen there is a ticker that goes across like this. Underneath it, in the ticker are the individual stocks, and the ticker underneath it, or the space underneath it, there are boxes, 3 or 4 of them that flip like this every 10 seconds or so, with the Dow, the Nasdaq, the S&P, the Nikkei, the 10-year, etc. This is when gold's at all-time highs. It's $3,050 that morning. This is last week. It's at its all-time high. If you would have told me at any point in my career that gold would be over 3,000 all-time highs in this crazy world that we live in, and would receive virtually no attention by the media, I'd say there's just no way that could happen. So I'm watching it and little, like aggravated by the lack of any type of recognition of gold and its all-time high. And I see it hits 3,050. And then I start to count how many times before it comes back up. And I'm noticing at the same time that I keep seeing Bitcoin. So it went 44 spins of the boxes, call it, a good 20 minutes before it came back up. Gold, and then 44 other things. At the same time, during those 44, I counted Bitcoin 9 times. So in 44 spins of the indice boxes, everything from the Nikkei to the 10-year to gold to Bitcoin, any of these major indices around the globe, CNBC wanted to show us the importance of Bitcoin 9 times as much as they did gold at all-time highs. And I think this is part of the reason that there's such a lack of understanding of gold. That has doubled the performance of the 10-year treasury in the last 25 years. That has, when you look at it, its performance last year was gold up about 40%, and the 10-year treasury up 4% in a market that is, net not seen any new central bank purchases of the treasuries at all since 2014. Now, that's not to say that there hasn't been buying of treasuries by central banks. There has, but the net, there's been more selling than buying. And that extra selling that normally went into treasuries, in my mind, has gone into gold. Why? Not only has it doubled the performance of the treasury over the last, at least since the beginning of the century, but it has no counterparty risk. And we talked a lot about that, the weaponization of the treasury market. You and I have discussed that at length. And equally as important, and going back to the lack of journalistic integrity in the media, gold is the only other tier 1 reserve asset in the world alongside U.S. treasuries. Why don't more people know that? It seems to me that should be something that everyone knows. If we know that the U.S. treasury is the supreme asset, the most liquid tier 1 asset in the world, why would we not be told by an unbiased media that gold has been transformed or raised to a tier 1 status? Well, we haven't. So that's one issue, lack of understanding, and gold has outperformed just about every traditional asset for better part of the last 20 years. It's as I mentioned, double the 10-year treasury. It's beat the S&P 500 just barely, 9.9 versus 9.6 since 2000 with dividends reinvested. Even when you see that the United States, as we talked about last show, has become a net importer of gold since November, it becomes even more interesting. With the largest deposits we've ever seen into the COMEX market ever, this should be front and center. In the February contract, 5.9 million ounces of silver or gold were delivered. That's the largest delivery ever for a single month ever. JP Morgan, who only buys for their clients, according to Blythe Masters, who used to run their metals desk, delivered $4 billion in gold into the COMEX in February. Why isn't there more talk about that? Who's got $4 billion as a client to have shipped into the COMEX? These are very interesting times, to say the least. Gold has surged by $500 an ounce in 213 days, from $2,500 to $3,000. That's the fastest $500 price jump in history. No talk about it, no fanfare. In my mind, the smart money has already shifted to precious metals and in front of potential market trouble. At the same time, you have the hedge funds with their lowest exposure to the Mag 7 in over 24 months. You have a 7-to-1 insider selling to buying. At the same time, you have institutional investors who have increased their gold positions by 45% since 2021. And as I mentioned, the metal has outperformed the S&P 500 again over the last 24 months. You can go back even further and find that to be the case as well. The big money is quietly positioning, and you all we hear about is the Mag 7 and Bitcoin.
Folks, what I saw at the health club that day, it's a microcosm of the larger deception we're all living through. You've got CNBC playing in front of me while I'm on the elliptical, and I'm watching that little index ticker at the bottom of the screen spin through asset classes, market metrics, and digital assets. Gold is at an all-time high that day, over $3,050 an ounce. Not just a good day, not just a spike. We're talking a new historic peak in one of the oldest, most important monetary assets on Earth, and no one is talking about it. So I start counting. 44 rotations of that screen before gold makes a second appearance. Meanwhile, Bitcoin shows up 9 times in that same cycle. What does that tell you? It tells you the financial media has become little more than a distraction engine. They want the public chasing headlines, trading hype, and ignoring the real shifts happening behind the curtain. This isn't just editorial bias, it's financial censorship. Now look, I'm not here to bash Bitcoin. I think blockchain technology has its place, but when gold hits an all-time high and the so-called financial networks barely acknowledge it, that's a red flag. That's not normal market behavior. That's coordinated distraction. That's part of a broader strategy to keep the public out of the real money trade, gold and silver, and locked into a digital casino where everything is pumped, dumped, and algorithmically manipulated. And let me remind you, this isn't just about media negligence. It's about the intentional downplaying of the one asset that competes directly with fiat currency and central bank dominance. Because if the average American started pouring into gold, physical gold, not ETFs like GLD, not derivatives or futures, but actual allocated metal, you'd start seeing real cracks in the system. Why? Because gold is an asset outside the system. It has no counterparty risk. It cannot be printed, frozen, or hacked. And central banks know this. That's why they've been buying gold at a record pace, even while CNBC acts like it doesn't exist. Let's look at the data. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2023, the highest annual total in over 50 years. China's central bank added gold to its reserves 17 months in a row, and other nations, Turkey, Singapore, India, Kazakhstan, are all stacking gold as if it's the final act of a long game they've been quietly playing behind the scenes. Meanwhile, what's happening in the US retail investment space? We're glued to the Magnificent 7 stocks and Bitcoin ETFs. We're told that gold is old, boring, outdated. And yet, gold has outperformed the 10-year treasury by over 2 times in the last 2 decades. It's even beaten the S&P 500 when adjusted for dividends over that same period. So let's put this into perspective. Over the past 213 days, gold rose from $2,500 to over $3,000. The fastest $500 increase in the metal's history. That's not noise, that's a signal. And the fact that it's happening without media fanfare, without retail mania, without hedge funds screaming it from the rooftops, that should send chills down your spine, because it means the smart money is already in. Think about it. Hedge funds have pulled back their exposure to the Magnificent 7 to 24-month lows, while institutional gold holdings are up 45% since 2021. And at the same time, insider selling has reached a 7-to-1 ratio versus insider buying. That's right. Executives at the very companies you're told to invest in are selling, while institutions are buying gold hand over fist. But the biggest bombshell? The United States has become a net importer of gold for the first time in decades. We're not talking about jewelry or trinkets. We're talking about record deliveries into COMEX vaults, including the largest single-month gold delivery in COMEX history, a whopping 5.9 million ounces in the February 2025 contract. Let's pause there. J.P. Morgan, whose metals desk was run by Blythe Masters, who once famously said the bank only buys for clients, delivered $4 billion worth of gold into the COMEX in February. So I ask you, who is that client? Who is powerful enough, liquid enough, and urgent enough to demand $4 billion in physical gold in a single month? It's not retail, It's not traders. This is sovereign-level accumulation, and it's being done quietly in the shadows without media coverage, while the rest of the world is chasing speculative dreams. It reminds me of that old saying, when the press tells you to panic, it's already too late. But this time, the press isn't even whispering, because when this goes, when the price of gold is revalued overnight, you won't be invited. You'll be left behind. And what about silver? While gold quietly makes history, silver is being drained even faster. The LBMA, COMEX, and Shanghai vaults are hemorrhaging silver to meet delivery demands. In London, 44% of the available float has been delivered out in just 3 months. That's not normal. That's a supply crisis. And it's now so bad that the LBMA quietly extended delivery settlement times from T+1 to 8 weeks, blaming lack of trucks. I don't know about you, but I've never seen logistics delay metal deliveries at the world's largest financial clearinghouse. This is not a truck problem, it's a default problem in disguise. And yet prices are still suppressed. Why? Because as I said earlier, paper silver is a casino. The daily trading volume on the LBMA is estimated to be 10 times annual global mine supply, with naked shorts selling silver they never owned to suppress the price and protect the status quo. It's a crime scene, and the victims are the public, those who trusted the ETFs, who believed the price reflected supply and demand. Friends, I don't care what CNBC tells you. I care what central banks are doing. I care what the COMEX vault reports show. And I care what smart money is buying with urgency while the public is distracted.
And there's still manipulation going on. One of the things that people are talking about right now is this really big short position in PSLV. You know, when people have asked me about buying ETFs, I say GLD and SLV are two of the worst products ever made, and on a multitude of levels. And if you read the prospectuses, pages 6 through 12, titled Risk Factors, you'll understand that. The custodian has done a tremendous job at distancing themselves from any fraud or liability. And guess who that custodian is? Well, in both cases, the primary custodian is JP Morgan for both SLV and GLD. And by the way, it's the company who paid a $920 million fine to the Justice Department for manipulating the metals market a couple years ago, the largest fine they ever handed out. Yet, here we are, they're controlling the largest silver trust in the world and one of the largest stockpiles of gold in the world alongside BlackRock. What's been going on with PSLV is, you know, when people would say, well, you know, I have to buy paper with the fund that I'm in or the account that I'm in, or I can't buy physical. Well, I would say buy PSLV. Eric Sprott's an amazing guy. I've known him a long time, although he's pretty much out of the loop now. I would always say that in a world of paper, PSLV and PHYS is the best choice. But you look at what's going on there and you got to wonder, is that even good advice anymore? You go back and listen to Rick Rule interviewed last time there was a massive uptake in, you know, blow off in silver and huge investment into PSLV. They had to go into the open market and buy everywhere and anywhere they could, whether it be London, whether it be the United States, COMEX, wherever they could. And they had a hard time filling it. So when there's greater demand purchasing of PSLV, which is the silver trust, they need to then go into the open market and buy silver. So conversely, if there was massive shorting of PSLV that overwhelmed the number of purchases, they don't need to go into the open market and buy copious amounts of silver. And we keep hearing about all of the silver shortage everywhere at the highest level in COMEX and LBMA. And the LBMA, there is a massive silver shortage, huge silver shortage in the respect that they've delivered 44% of the float, the amount of available silver in the last 3 months, and now have gone from a T+1 settlement in London, meaning you do your trade on Monday, that's T+1 Tuesday. Silver should be moving on Wednesday, and they're now saying 8-week delivery delay due to constraints with lack of trucks and personnel. I mean, it sounds more like a default to me. They're freaking out. And you're seeing huge deliveries coming off of LBMA and COMEX and the Shanghai Exchange. Big money is standing for delivery, and silver is becoming hard to get. And when you have huge naked short positions, where on the LBMA market, they're trading 3.5 times annual global mine supply every single day, according to some of the LBMA market analysts.
Let's pick up right where we left off, because this is where things really start to get intense. Here we are watching gold hit all-time highs, moving $500 in just over 200 days, the fastest price spike in history. And what do we hear on CNBC? Crickets, nothing. Meanwhile, they parade Bitcoin across the screen 9 times in 20 minutes. And let's be clear, I'm not anti-Bitcoin, but there's a reason they want you talking about Bitcoin while they're buying gold behind the curtain. It's called narrative control. Because if the average American truly understood that gold has quietly become the only other Tier 1 reserve asset in the world, alongside US treasuries, they would start asking the hard questions. They'd want to know why they were never told. They'd want to know why their financial advisors never mentioned it. And they'd want to know why central banks are accumulating gold at the fastest pace in 55 years, while retail investors are being told to load up on meme stocks, tech ETFs, and digital tokens. Let me spell this out. Gold is a Tier 1 asset. That means it's treated as risk-free on a bank's balance sheet, on par with cash or government bonds. This wasn't always the case. It changed under Basel III, implemented after the 2008 crisis to make the financial system more resilient. But here's the twist. While gold got upgraded to Tier 1, silver didn't. And that was no accident. Silver is still viewed by the regulators as too volatile, too industrial. But ironically, that's exactly why it's even more undervalued than gold. Silver is still treated like a commodity by regulators, but it's being treated like a monetary reserve by sovereign buyers. And what makes this so sinister is that the media doesn't mention any of it. Ask the average person on the street if gold is a Tier 1 asset, and they'll look at you blankly. Ask them why central banks hold gold at all, and they'll shrug. We've been so thoroughly conditioned to ignore real money that when gold hits record highs, the silence is deafening. Now here's something I want to hammer home. The media doesn't report what matters. It reports what sells. And who are the biggest advertisers on financial media? Banks, ETF sponsors, fund managers, the very institutions that make their money keeping you in the paper world. The moment you take your wealth out of stocks, bonds, and mutual funds and into physical gold and silver, you stop feeding the machine. You exit the casino, and the casino hates that. But central banks aren't playing the same game. They're not buying Bitcoin. They're not buying tech stocks. They're buying gold, not futures. Allocated, physical, sovereign-grade gold, quietly, consistently, and relentlessly. And here's where it gets even more critical. Let's talk about treasuries. For decades, US treasuries were the ultimate safe haven. They were the most liquid, widely held debt instrument on the planet. But that's starting to change. In fact, since 2014, the net position of foreign central banks in US treasuries has been declining. Yes, some still buy here and there, but on balance, they're selling more than they're buying. And where is that excess liquidity going? You guessed it, gold. Why? Because the US Treasury market has been weaponized. The moment the United States used sanctions to freeze Russian central bank reserves in 2022, over $300 billion in assets, it sent a message to every country in the world. Your dollars aren't really yours. If you fall out of political favor, we'll lock you out. We'll cancel you. This is what we call counterparty risk, and it's something that gold has exactly zero of. No counterparty, no default risk, no SWIFT sanctions. Gold doesn't care about politics. It doesn't care about who's in office. It doesn't even care about Wall Street. It just sits there, preserving purchasing power, immune to human folly. And that's why countries like China and Russia have been dumping treasuries and stacking gold, not just to hedge against inflation, but to prepare for a post-dollar world. A world where settlement isn't done in dollars, but in commodities. A world where gold regains its role as the anchor of international trade. We're already seeing the infrastructure being laid. Look at the BRICS alliance. Brazil, Russia, India, China, South Africa, and now countries like Saudi Arabia, UAE, and Iran are joining in. They're building a new commodity-backed settlement system, likely tied to a blockchain ledger that will bypass the dollar entirely. And gold will play a central role in it. Do you think that's a coincidence? Or is it perhaps the largest global monetary shift in a generation, unfolding right under our noses? Meanwhile, back in the United States, we're still obsessing over Tesla, Nvidia, and Bitcoin. But let me ask you this. If Tesla dropped 40% tomorrow, would that change the world? Probably not. But if gold were to revalue overnight to $5,000 an ounce, Or if COMEX LBMA couldn't meet delivery obligations, that would shatter the financial system as we know it. That's how fragile this game really is. And it's not just gold. Silver is the canary in the coal mine. Silver is disappearing from inventories across the globe. London Bullion Market Association, COMEX, Shanghai. The float is being drawn down rapidly. At the same time, industrial demand is exploding. Solar panels, EVs, 5G, military tech, medical applications, all of it needs silver. And the supply simply isn't there. You think a media blackout on gold is bad? Try silver. There is no coverage at all, even as we see delivery failures, delays, and surging premiums at the wholesale level. In fact, the US Mint had to halt production of several silver coin programs in 2023 due to supply constraints. Yet somehow, the spot price remains flat. It's a paper illusion, a matrix of contracts and leverage meant to pacify the masses. But when it breaks, it won't be slow. It will be instant, violent, unforgiving. And if you're not holding physical gold and silver, you will be left out. Because in a system reset, paper promises don't matter. Only real assets matter. Let me wrap with a tweet from someone I respect deeply. Luke Groman, macroeconomic analyst. Gold is what central banks buy when they don't trust each other. They're buying a lot. Think about that. Endgame. That's it in a nutshell. We are moving into the endgame, a system reset, a bifurcation between those who hold real money and those who trust paper. And the longer you wait, the fewer your options. So what can you do? You take action now. You get your wealth out of the system. You buy physical gold and silver, not ETFs, not futures, not digital tokens backed by trust. The real thing, you become your own central bank. Because when the reset hits, and make no mistake, it's coming. It's going to be too late to prepare. No one's going to ring a bell. No one's going to tell you it's time to buy. They'll just close the doors, change the rules. And if you're not already on the lifeboat, you're staying on the Titanic.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.